Hey Alan, I have been learning tax planning for corporate owner managers, but everything feels too perfect in examples. What actually happens in real life?
That is a great question, Raj. In real life, owner-manager situations are messy. Clients mix personal and business expenses, records are incomplete, and withdrawals are not tracked properly.
So this topic is about handling those messy real situations.
Exactly. In this part of tax planning for corporate owner-managers, we focus on common real-world issues and how to fix them professionally.
I assumed business owners keep everything separate.
In reality, most small owner-managers treat the corporation like their personal bank account.
What do you mean by that?
They pay personal expenses using corporate funds. They transfer money without documentation. They assume everything is deductible.
That sounds risky.
It is. Your job is to separate business and personal transactions clearly.
When I review transactions, how do I know what is business and what is personal?
You must question every transaction. If an expense benefits the owner personally, it is not a business expense. If it supports business operations, it may be deductible.
What are common red flags?
Groceries, shopping expenses, mortgage payments, tuition payments.
So I should never assume anything.
Exactly. Always verify.
I keep hearing about shareholder loan accounts. Why are they so important?
Because most withdrawals end up there when they are not salary or dividends.
So if a client takes money casually, it goes into this account.
Yes, and if it is not cleared properly, it becomes taxable income.
Can you give an example?
If a client takes $100,000 and does not clear it, CRA may treat the full amount as income.
That is a big problem.
It is one of the most common real-world issues.
How do we fix messy records?
We start by reviewing expense reports step by step. Collect all documents like credit cards and bank statements. Analyze each transaction line by line. Extract business expenses. Treat remaining as personal.
So not everything on the statement is deductible.
Correct. Only valid business expenses qualify.
Credit cards seem confusing.
They are the biggest source of errors. Clients use one card for both personal and business. Then they pay it using corporate funds.
What should I do?
Break down every transaction. Identify business portion. Move the rest to shareholder loan.
So the full payment is not an expense.
Exactly. Only the business portion is.
How do we handle vehicle expenses?
There are two methods. Kilometer method. Actual expense method.
Can we use both?
No. You must choose one.
Can you give an example?
If business kilometers are 13,375 and rate is 0.49, the expense is about 6,553.
So documentation is important.
Always keep a mileage log.
What about working from home?
Home office expenses can be claimed proportionally.
How do we calculate that?
Take total home expenses and apply the workspace percentage.
Example.
If total expenses are $31,467 and office is 12%, deduction is about $3,776.
So it must be reasonable.
Yes, CRA expects a fair allocation.
What is the role of the general ledger in this process?
The general ledger shows all transactions, including shareholder drawings.
Can it be misleading?
Yes, clients often underestimate withdrawals.
Example.
Client thinks they took $60,000, but ledger shows $122,000.
That is a big difference.
That is why we analyze before making tax decisions.
Once we identify expenses, what is next?
We record proper journal entries. Debit expense accounts. Credit shareholder loan.
What does that achieve?
It reduces the shareholder loan balance and cleans financial statements.
Then we decide compensation.
Yes, based on the final balance.
I thought owner-managers do not pay EI.
Often true, but not always.
What determines it?
Ownership percentage. Relationship with the company.
Explain that.
If ownership is more than 40%, EI is exempt. If less than 40%, we check if they are related or independent.
So it depends on facts.
Always analyze each case.
What if a family member wants EI benefits?
Then we must treat them like a real employee. Same working hours. Same salary structure. Same rules as other employees.
And then,
Request a ruling from CRA or Service Canada.
is approval guaranteed?
No, it depends on how strong your case is.
What if the client wants to avoid EI instead?
Then we prove the opposite.
Meaning,
Show non-arm's length relationship. Show flexible work conditions. Show special roles and control.
so treatment matters.
Exactly. That determines EI status.
Is there any simple tax-saving benefit we can use?
Yes, the $500 non-cash gift rule.
How does it work?
Company can give up to $500 in non-cash gifts. Employee pays no tax. Company gets deduction.
What are the rules?
Must be non-cash. Must be within $500 including tax. Must be given to all employees.
What happens if rules are broken?
It becomes fully taxable.
Can owner-managers claim expenses personally instead of corporation?
Yes, but it is risky
Why would they do that?
because personal deductions can give higher tax savings.
What is the risk?
CRA may challenge if conditions of employment are not valid.
So we need proper documentation.
Always. And explain risks to clients.
What if payroll was not set up and client already took money?
Never just report it on T1 as other income.
Why not?
CPP may not be calculated. CRA may reassess. Penalties and interest may apply.
What is the correct approach?
Use proper T4 or T5, even if late.
When we choose salary, do we only consider tax?
No, we must consider total cost.
What else is included?
WSIB premiums, employer health tax,
Example.
salary of $100,000 may cost over $110,000 after these costs.
So salary decisions affect more than tax.
Exactly.
This was a lot. Can you summarize what I should remember?
Real life is messy and different from textbooks. Always separate personal and business transactions. Shareholder loan is the most important account to monitor. Documentation is critical for every claim. Compensation planning should only be done after cleaning records.
So my role is more than just filing taxes.
Yes, you are solving problems, advising clients, and structuring their finances properly.